ladies and good evening, everyone, and welcome to this webinar that's been exclusively arranged for clients who, within Cred. And this is regarding the commercial real estate space, which is really, seeming to do really very well. In fact, if one looks at the last, say, 6 or 7 years, the commercial real estate market has been on the upswing, and this trend sort of even continued all until COVID. There was a lot of resilience seen in the commercial real estate market during COVID, and the market experts are now of the opinion that overall in 2022, 23, and beyond, we should be tracking some healthy growth rates as far as the commercial real estate space is concerned. So interestingly, while most of us would have been reading about, news items or news bites on commercial real estate and how it's posing out to be a good opportunity, we've partnered with Axis Asset Management. So Axis, through its real estate practice on the asset management side, actually is providing an opportunity for investors to participate in the commercial real estate story via its offering. So to understand more about what is the opportunity that's available at hand and what does Axis have to offer, we've invited today Mr. Balaji Rao. Balaji is the managing partner for the real estate practice at Axis AMC. Balaji is a veteran in the Indian real estate industry. He has over 3 decades of experience in property markets in India. And he's amongst the few industry experts who has assumed leadership roles across various aspects of the real estate sector, associated with some marquee institutions of the industry, both as a developer as well as a fund manager. So we thought, who better than him could really take us through the entire thought process behind, why Axis thought of coming up with a fund catering to the real estate commercial space at this point in time. And then maybe, also delve a little deeper into how they're going to structure this opportunity via the fund. So with that sort of brief introduction and the context, Balaji, I would like to invite you into the call and, over to you to take the investors through your views on this space and then a little bit about the fund. Thank you.
Thank you, Saurabh. Thank you, participants, for coming into this webinar. I hope it will be very useful for you. Before I kickstart on the particular offering we have today for you, which is the Commercial Real Estate Fund, we have in collaboration with Tishman Speyer, I would also like to set a bit of a context on what's happening in the real estate sector as a whole. So the agenda as we go by will be more first on the real estate class as a asset avenue for investment. Then we will talk about commercial real estate and then the fund itself, and finally the development manager's credentials, which most of you might be knowing about them, but we would still touch upon those points. I can take a pause sometimes in between and I can answer questions, or I can run through this presentation for the next 20-30 minutes, and then we can take the question and answers as they come up. And so please feel free if you feel that there's any place which requires further clarifications or you need further insights on. So basically, to talk about real estate as an asset class, the 3 things which are going to happen in real estate in the coming decade will be: 1, is going to get more and more corporatized and professionalized. What I mean by this is you're already seeing consolidation, you're seeing mergers, you're seeing IPOs by real estate developers. So there's a whole process by where you are seeing real estate as a sector is coming more into the light, and especially into the spotlight some places, because it's not going to be in the dark ages as we had seen it earlier, and it was struggling to become transparent. Now we are far more transparent, we are far more professionalized, it's far more corporatized. That's already underway, and I think we have come a far distance in that. The second aspect of real estate which is going to happen, and this is where the key presentation of ours revolves around, is the financialization of real estate. What I mean by that is, previously real estate as an investment class meant that you were holding title to a physical asset. And that is slowly going to give way that you can hold and take exposure on real estate as an investment opportunity by way of financial instruments. And it's no more going to be just having to hold it as a physical asset. And this you have seen already happening in gold and other commodities. So real estate is fast following that path. So it will be the wave of financialization which we are going to see in the coming years. And finally, there will be a digitization in real estate, which is also happening as we speak, whether it is by way of land records or approvals or ERPs or, in the construction techniques, in sales techniques, in CRM, in touch and feel. So the whole digitization process and technology has seeped into real estate in a big way. And prop tech as we know it today is becoming much bigger. So these are three are going to play out in the coming years in the real estate sector. Having said that, let us proceed to how we view real estate, irrespective of whether it is residential or commercial. How does real estate really pan out in a value chain? So when I say it's in a value chain, I say that there are three key sort of timelines which you see in any real estate development. One is when somebody has invested in land and is holding to it. So this is the core of real estate where the land is held because we all believe land has value. They don't make it anymore. And so land appreciates over time. And most of us have made money on this aspect. Even earlier generations, most of the household wealth and the billionaires came out of real estate. Today it is technology maybe overtaking it, but earlier on it used to be land. And even the tech giants today invest a lot in land as a sort of a counterbalance to their weight in tech and digital assets. But so land, if you hold, has its own value. And the land itself can be agricultural, non-agricultural, it can be infrastructure or others. And there are various types of land. And in the land holding, the biggest appreciation that you'll see as we go forward in the next slide will be when we convert the zoning from agricultural to non-agricultural. The second value is created in the development process. That means we take the land and then we start master planning it based on its zoning and approvals which we get from the MOEF, that is the Ministry of Environment and Forest. And we master plan it and we figure out how do we actually build it out, that piece of land. So there is a development process which takes place in this timeline, and there are margins which are there in this whole development process. This is where you see most of the developers participating in, and this is where they try to capture the development margins in the land. The last stretch is what we call the built out stage, when it is a completed building, whether it's residential or commercial, it's already occupied, maybe even the project is completed, if there is it's a township or a complex. And finally, in that built out stage, it becomes an infill. Infill in real estate means it's completely actually built out. There's not much land available. So if I take any city, an infill location will be the central parts of the city. I can't really go and do far more development in sort of Pedder Road or a Nepean Sea Road or a Cunningham Road or even in a Jorbagh area in Delhi. So these are all filled out areas and they have their own appreciation, not because there are further developments going to come, but it has been fully gentrified. So these are the three types of value you can create in real estate across different timelines. And when we look at what are the timelines and what are the appreciation rates that go with it, you will generally see in the land value, when we try to create, they are upwards of 30%, because this is where the highest risk and the highest risk return plays out, frankly, because the land has its own problems of being able to be held on to, its entitlement, its security, as well as its policy. It can be taken over by the government sometimes, or it can come under some sort of a reservation. So land to hold on to is a very difficult task. And there is a section of people who are very good at, they are called land aggregators, landholders. They do this land sort of a piece of development and they get high appreciation. But it also takes a long number of years to convert land. So this is never very suitable for retail or institutional investors in an organized space. The other space, which was the development timeline, is where most of the retail and institutional investors take part. That is where they try to come into a development process early on at a greenfield stage, wait on till it is fully developed, and then try to exit out of it by selling a fully developed sort of an apartment or an office space or an industrial plot, whatever be the asset class. Here you have a medium return and a medium risk, what we call, where there is a risk of execution, there are risk of approvals, there's a risk of stop orders, there's risk of litigation, but the returns are upwards of 20%. Because here is where the developer has to put in all his efforts to create reality out of the vision, out of the brochure which he gives you. And finally, the safer players where there's low return and low risk is when you turn towards what we call the completed buildings, whether it's residential or commercials, when you buy a property and rent it out, or you participate in today's financial world in a REIT, because they are sitting mostly on completed property and enjoying the rentals, and they distribute the same as dividends. So this is where there is a low risk, there's a low return, and this is where most of the low risk retail investors would like to participate in. Generally, if you see in the time period where we try to, I take to usually put it into two buckets, that is pre-2005 and post-2005. 2005 being a sort of a year where we allowed FDI to come in a big way, and foreign investors came in from the institutional, from the pension funds, from the endowment funds, and they came in a big way. So pre-2005, the funding in real estate used to happen from either the promoter equity, that is the developer's own equity, or a little bit of bank lending as construction finance. And mostly it used to be pre-sales, where they would be taking bookings for their projects, and that money was collected and used for the construction. But post-2005, with the advent of the institutions, the high net worth individuals, the family offices, the retail investors, they all started pouring in because they saw this as an asset class where they could invest money without having to be a big ticket size or having to have deep pockets for it. So this was where we had seen slowly the advent of financialization in its first wave, which happened in India. And that first wave, as most of you all are aware, didn't go very well with India because the developers were not in the professional corporatized way. They tried to take advantage of some of the investors, and the investors had absolutely no way to enforce some of the contracts because of our own judicial system and the way it operates. So there was a lot of what I would call a heartburn in this first wave of investments into real estate, both from institutions and high net worth individuals. And those scars still remain for a lot of people. So today, many people come and ask me, oh, I did invest in real estate financial instrument somewhere in 2006, 2007, and they just disappeared, or they've become really bad and didn't get my money back. I agree with them. But then things evolve. If you look at any industry, whether are stock markets, whether are mutual funds, they have all evolved over time. And one of the biggest ways of evolving was when a regulator comes in. Even SEBI came in after the Harshad Mehta scam. That's when the stock markets became really organized and evolved. And similarly, if you see, when you have the RERA, which has come in 2016 in India, that is when the real estate market started getting more and more regulated, more and more transparent, and has evolved. So it is not going to be the same story again and again. It is a different story because you're now seeing a more transparent, more regulated sort of a sector or industry. So what is the financialization of real estate, if I can take 2 minutes on it? The various ways you can invest or participate in the real estate value chain by way of trying to see in which timeline do you fit in or which asset class you fit in would be these following things which you see on the screen. One is the listed equity space. We have over 40 real estate companies which are listed. Some of them are very active in the market. They have liquidity, they have marketability, and even now there have been IPOs by the real estate companies. Very recently, we saw Shriram Properties successful IPO. We have seen a couple of days back, Rustomjee or Keystone Realtors IPO being successful. So we have these listed equity players who come in and give a chance to investors to participate in the whole real estate business and the margins thereof. Then we have the private equity, which are usually the foreign private equity funds which came into India and still continue to be in India, who maybe have larger, deeper pockets, and they cut bigger checks to participate both in the equity of residential as well as in the commercial. Some of the most successful ones, which you have seen, like Blackstones, the Brookfields, the GICs of the world, they have tried to have a bias towards commercial because they find it a far more resilient sector and a far more sort of a sector where you can see returns and visibility of returns are there due to lesser volatility in the market. They are not so prone to property cycles as much as residential real estate. So you had the private equity players who had come in. And then you had the AIFs. The AIF is nothing but an Indian private equity regulated by SEBI, and there are various categories in it. And real estate AIFs come under category 2. And these have been growing at a very rapid pace and have almost reached 7 trillion in this year as a AUM under the AIF. So this is now one of the fastest growing classes which we see amongst the funds. And then we have the REITs, which became popular. The first REIT just happened before COVID, and then it started. There are 3 REITs now listed on the bourses in India, and all the 3 are doing well. And the most beautiful aspect of this REIT has been they have been able to sustain themselves during the COVID. It's not that they collapsed, because the commercial real estate sector by itself did not collapse, contrary to what people believe and feel that, oh, it's become a hybrid work culture. So, offices are the thing of the past. Not at all. In fact, offices are still being absorbed and REITs are still doing well and they're still distributing dividends. So this is the REIT. So you can participate in real estate, not directly by holding physical property, but indirectly through these instruments also. And this is what we mean when we say that there's a financialization of real estate that has happened. So when you look at the investment opportunities, which have been happening right from the public equity to the REIT, to the fractional ownership, which has suddenly come up of late, and the real estate AIF, they all are in a certain asset class. They usually sometimes are in a certain timeline, that is, whether it's in the development stage or in the finished product stage, and accordingly, they have their own volatility. We usually find when there's more volatility, the returns are also under a cloud. When there's less volatility, the returns are far more stable. So AIFs by and large are closed-ended funds. And so there's lesser volatility because you don't see investors going in and out. They are there and they go through that cycle. And thus the returns usually tend to be much better, especially if they are in the right segment at the right time. So there are the pros and cons for various of these, like whether when you have a listed equity space, you have higher liquidity, you'll have a ownership in the business, but it is also very volatile because it's based on how the stock markets are doing and all the allied factors. When you have REITs, they have higher liquidity, but they generally only will distribute the rental, what they get. And there's very little development business being done by the REITs because as per regulation, they cannot break the cap of the 20%. The fractional ownership is also a good idea where people are coming together to buy a property, but unfortunately it is very low on government and it is not regulated as at the moment by any authority. So that leaves us with the AIF, which is a well-regulated sort of a fund instrument by SEBI. And depending upon the AIF, whether it is going towards equity or debt or residential or commercial, and based on one's own risk appetite, one can partake and participate in these AIFs which are available in the market. So this is what I wanted to show as the investment options. This slide talks about all the various changes that have happened in the real estate industry, and most of you all are aware of it. Some of the biggest game changers have been definitely the concept of RERA coming in. IBC has also helped us. Then you have the demon, which has happened. Then the GST. All this has been happening pretty rapidly over the last 4 or 5 years. Today, we have the Model Tenancy Act being implemented in states. And so you have seen that there's a complete overhaul of the legal and the regulatory framework in which real estate operates. And this is creating its own impetus to the growth of this industry. And so it is not the same thing as we keep on talking about what happened 15 years back or 20 years back. It's a very different world out there, and we need to appreciate that. The investment pattern, what we see, PE in different asset classes to set the tone. PE has gone into various asset classes, and from industrial warehouses to data centers, you hear about residential, affordable housing, co-living, you have heard about malls, hospitality. So PE has become pretty much widespread as we see it, and they are very opportunistic. So right now, what is very the flavor of the year or the decade, if I can say so, are the warehouses, data centers, commercial offices. Previously, it was the flavor of the residential townships. It might come back again. In the future, the flavor might change. So this is the constant way PE keeps on looking at it. And as we see alternate classes emerging, we are finding more and more that commercial has gained at the expense of residential. And this is well illustrated when we look at the overall real estate investment in India. You will see the bulk of the investment has come in the last few years, and it has been pretty much constant. And we expect another $4 to $5 billion even in this year as a real estate investment coming in to the industry. And out of this, there will be the maximum which comes is on the commercial side. So the bulk of it is coming from the commercial side. So what we really realize is, as an institutional investor, as a HNI investor, as a family office investor, the commercial sector has been earmarked and focused upon by most of these investors. I take a pause here. Are there any questions anybody wants to ask before I delve into our commercial RE fund and its features?
If anyone has questions, they can also type it in the Q&A window. Balaji, I guess you can continue, and maybe you could take all the questions towards the end.
Sure. So let's now look at what is the fund we have on offer out here, which is what we have assembled here for. So Axis AMC felt that it wanted to enter the commercial real estate space. And we were wondering whether in a commercial real estate space, which way do we enter? Which timeline do we enter? Do we go equity or debt? In commercial, debt has no meaning because commercial nowadays, there is no fractional ownership so much, and everybody waits for the whole building to be tenanted before it is sold. So if you have to take that entire risk of the building getting tenanted out, leased out, and then sold, this sense of being in debt has no real value as much as being in equity. So in commercial, we decided we will do an equity product, and we decided the timeline we want to do it in is going to be in the development phase. So when you want to do it in the development phase, then Axis needed a development partner. So there are two choices we have. One is we can create a blind pool fund and then raise money from all of you all and then go and figure out which developer we want to give it to and negotiate with each developer for each project. How do we do it? Or we can create a platform. And what we decided was to create a platform which has equal sort of a collaboration between Axis on one side and Tishman Speyer. We will talk about Tishman Speyer towards the end, but it's needless to say, I'm sure quite a few of you all know about it, but Tishman Speyer are one of the world's largest developers. They have roots which go back to over 100 years. They have I think, constructed over 220 million square feet and have $120 billion worth of construction to their credit. They own Rockefeller Center, MetLife building in New York, and they have been in India also for the last 15 years. And if they're one of their iconic projects has been the Wave Rock project in Hyderabad in the Gachibowli district. And this is where Apple is headquartered. The Apple's country headquarters is there in Wave Rock, and they occupy about 500,000 out of this 2.4 million square feet project. So we decided we'll create a platform with Tishman Spire so that we do not shop around for developers, but we get an equally reputed, one of the world's best developers as a partner, and we provide the capital for their projects. And this is an exclusive tie-up we have with Tishman. So the whole idea was to create the best of class, world-class buildings across the top cities in the development stage of a commercial project so that we can capture the development margins that are available in this commercial real estate sector. And both Axis and TS together are putting in 10% of this fund, which is targeted to be 1,500 crores. So we are putting in 150 crores into this fund as well as in the SPVs, so that 150 crores is coming from both of us. Axis is putting in 100, TS is putting in 50, and each of these projects which will be housed in an SPV will be controlled jointly by the Axis and the TS directors. The whole idea of the beauty of this partnership lies that unlike many funds, our destiny is in our hands. I don't have to really go to negotiate with another builder to get my money back as a debt or as equity. I control the project, whether there's a time overrun or a cost overrun. I figure out what sort of corrective measures to take, and I can actually salvage a project also without any interference from some other third party. And that is, I think, and because we too are large institutions with our own check and balances, with our own professional and brand values, I think this is where the real crux of the matter lies as to why this fund is so differentiated and why it is so attractive to an investor. Because it mitigates by itself, this partnership, most of the risks which we think that are associated with commercial development. To just give you briefly so that it doesn't get too monotonous, commercial real estate, as per figures are concerned, pre-COVID, it used to have a net absorption of around 50 million square feet, net absorption. During COVID, 2 years, 2020, 2021, that net absorption fell to 25 to 26 million square feet. It became almost half, but there was no degrowth. There's a difference in the growth rate being half than to say that people were just giving up spaces. No, the growth had become half during the COVID years. And during this calendar year of 2022, the latest reports say the first 3 quarters of this calendar year already show an absorption of around 40 million square feet. And we believe that we will cross this year back to the pre-COVID level or even higher than that. So there has been a complete rebound in the commercial property sector, contrary to most of them thinking that our companies or corporates giving up office spaces, they haven't. The reason being it's a B2B business. People have a longer term vision. It's not volatile. It's a pretty resilient market where people see whether they really need to give up space. Most of the IT companies, as well as the bigger companies which are doing their offshoring as global capability centers in India, they need space. They're recruiting people. The NASSCOM feels that they almost contribute 100,000 people extra every quarter. So when you have so many people being recruited, you need the space also to accommodate them, even if it is a hybrid work culture. That's one. Two, the spaces which are today required need to be far more advanced in its own way. It cannot be those typical cubicles because we want to look at the safety, the health angle, the environmental angle. So all this is requiring people to need that office space and require it even more. Besides this IT, we also have the space requirement coming up from the startup culture where all the new startups need spaces, from the flexi work industry, like the WeWorks and the co-works, they all need spaces. So when you look at all of them put together, we are seeing on the ground headline figures, they're constantly growing. So we don't believe that the commercial property sector is on a downswing. And India has roughly around 700 million square feet, which is more or less similar to what is in stock in the Manhattan district of New York. So you can see the contrast that we have a long way to go before we think that we are saturated the commercial property sector. So I think this is a good sector and it is resilient and it is bound to grow over the years. And the proxy of it is when you see the REITs which are there, they have come up, they have performed. During COVID also, they have been giving dividends and they have been showing you as a proxy that commercial real estate sector is here to stay. And this has also provided an exit for all the development projects. And that has been a big, big plus when we go ahead. So when you look at the headlines, they are all there for all of us to see, whether there's strong leasing activity or office space demand is going up or is bouncing back. And the whole real estate recovery is being now considered as an engine to the economic growth because it's more domestic oriented. So I feel as we are looking, we are sitting at the cusp of a real estate boom, especially in the commercial sector also. Coming to the fund details, we have broken up to say where are the risks, because one of the most common questions which I encounter is, there are risks associated with real estate. Are you sure you can mitigate them all? And so what are these risks? The risks can be at the land selection, acquisition, they can be on the approval process, they can be the development process, they can be the leasing process, and they can be the exit. So there are risks at every level. So I will not going to underplay and say there are no risks. The way a fund manager tries to deal with it is to see how does he mitigate the risk? How does he ring fence it? So the way we look at the ring fencing is one, through our due diligence process. Because there's two axes as well as Tishman, we have a double filter. There are two ICs for every project to be approved. It not only has to go through the IC, the investment committee of Tishman Spire, but it also has to pass the investment committee of the Axis Asset Management. So there are two sort of ICs through which we have to take each proposal through. The due diligence is always conducted by the best of the legal firms and the big four audit firms so that we know what we are stepping into. And best of all, the approval processes, the land title processes, we are trying to ring fence this by ensuring even before we enter into a definitive agreement, whether they're all there in place. So are we going to buy agricultural land or something which is industrial and turn it into commercial? No. We are going to buy land that is being zoned for commercial. We are going to buy land that is outside forest areas or water bodies or CRZ. So we are going to ensure that at the due diligence stage itself. The second point of development for most people comes from the financial closure. Here in each project, we intend to take a debt equity of 1:1. So whatever equity we are putting in, we are going to take a debt of also equal amount. And so we will have financial closure of each project even before we break ground. So there's no question of running out of money because we don't have money or we haven't raised the money. So each project will have its own financial closure. So we don't believe there should be time and cost overruns because these will be contracted out to large contractors. The leasing and the exit is where the strength of Tishman really shines besides the design, development, execution, because Tishman has connections with over 2,000 global clients on a continuous basis. So their relationships are so high that they usually become the first port of call for most of them. To give you an example, they have done the Goldman headquarters in New York. And so they were the preferred choice to do the European headquarters in London. And when they were doing the India headquarters, again, Tishman came in. So whenever such sort of connections are there, they tend to leverage it. That is why even for that Apple leasing in Gachibowli, what I just spoke a few minutes back, it was Tim Cook who came to inaugurate it. And so these sort of relationships and connections of Tishman is what gives us the confidence to say that these buildings will most probably be fully leased out even before they're completed. And not only fully leased out, they usually command a premium in their lease rentals over all the neighboring projects. So if you look at the Wave Road project as a proxy, they command at least a 10 to 15% premium over the neighboring projects. And they have exited this out by selling it to the German insurance group, Allianz, at a record cap rate. So these are the indicators for us to say that when you make an iconic grade A building with a good developer and have a good tenant roll call, you are bound to have a good value to the building, which will enhance our development margins. So putting all this together, we intend to mitigate the risk across these stages pretty effectively. The fund focus, it would be primarily equity, as I said. It would be a risk-adjusted return, and it will be back-ended. Being equity, you will get the money back only at the 6th and the 7th year, and they will come in as capital gains. We will draw down the money in the fund over the first 1.5 years, and we will be returning the money in the 6th and the 7th year. The asset class which we'll create will be commercial. They will be grade A buildings, and we'll have complete control over the development process. The geography, what we are looking at are the top 7 cities. And most of the time, we will be picking and choosing those micro locations that have a positive supply and demand dynamics. And so if you look at the way the fund has been structured, it has been structured in such a way that we are extremely focused on what we want to do. And already in our pipeline, we have term sheeted a couple of deals so that we are very clear that what is it that we want to achieve out of this fund and how are we going to do it, whether it is the leverage, whether it is the geography, whether it's the asset class, whether it is the type of product that we are going to create. So it's not a blind pool. It is pretty much well focused on what we want to do with this fund. The fund terms, we intend to raise about 1,500 crores with a green shoe option. It is a 7-year fund, closed-ended. We intend to have a commitment period 24 months from the date of final closing. Each deal which we do would be 150 to 300 crores. And we are expecting to have a gross return of about 21 to 25% as a CAGR pre-tax at the project level. And the fees will be the usual 2%. We have a range based on the ticket size, and we have a hurdle and a carried interest of 15 over 15. These are the fund terms broadly, what I wanted to show. The capital commitment will change, and the management fees changes as per the capital commitment, whether you're in the 1 to 5, 5 to 10, or greater than 10. And the upfront contribution can also be adjusted based on this capital commitment which somebody makes. And finally, I will quickly take you through Tishman's development manager credentials. As I said, they are one of the world's largest. They have the old building, which everybody is well aware of, is called the Rockefeller Center. One of the new iconic buildings they're making is the Spiral, which is in Hudson Yards. And this is very iconic because they're trying to create a breakout space, as you can see from the picture, on each floor. And it runs around the building like a spiral. So that this is trying to maybe take into account the need, as people say, not to be in a complete boxed-in environment, but to have breakout spaces, have greenery in each this thing, so that it becomes more environmentally friendly. So this is one of the newer developments. And if you see today, they have approximately 1,650 tenants in all their properties across the world. And their current AUM is around 67 billion, because most of them they make and also sell. But at the moment, they are having a gross value of about $67 billion. So the development manager expertise is their in-house expertise. They are not only into development management, but they do the design, they also do the leasing, they also do the property management. Even today, if you go to Wave Rock, though it's a 10-year-old building, it almost looks new. So it's not something which somebody would think, oh, it's such an old building. No. So the question of property management, leasing management, design development, all this becomes very critical, especially when we are doing a grade A iconic structure. And that is what Tishman brings to the table as a joint venture partner. And the leasing expertise is something like a roll call. Some of the biggest names you have seen, whether it's Pfizer, LinkedIn, Wells Fargo, Deloitte, MetLife, they're all their tenants across most of their buildings, whether it's in New York, whether it is in Paris, whether it's in Berlin, whether it's in Shanghai, whether it's in Rio or Sao Paulo, or even in Hyderabad. So these are some of the better known buildings. The Springs is in Shanghai. You will see the Tornestorm and Omniturm. These are in Frankfurt, Germany. So these are some of their better known iconic structures that they've created around the world globally. And finally, in India, you will see that what they've created in Hyderabad, the Wave Rock project. In Bangalore, as I said, they built their Goldman Sachs headquarters. And in Pune, they are currently developing also a large project with about 2 million square feet. With this, I end my presentation. And if there are any questions, I'll be happy to take them.
Thanks, Balaji. I think that was quite comprehensive. So participants would request you to type in your questions, if any, for Balaji. And we also have Sushant from the team. He's in the investments team working closely with Balaji at Axis.
Yes, I'm sorry, I didn't introduce Sushant. Sushant is a principal with us, and he has also had tremendous experience of 15 years in real estate. And he looks after the investment and the asset management side also. So, and he's had experience with Portman. Portman are one of the biggest firms from US who have also participated in the Indian real estate space during the early 2000. So if there are any questions you require about the fund, about the collaboration with TS, or about the commercial sector, we would be more than happy to address.
So while we wait for a few questions, I think there's one already in the chat window. I think it's specific to do with which are the key sectors within, or who are the key players within the office sector space in India, whom you think will really drive their growth. And out of, maybe as an extension, if I can ask, if out of the 2000 odd relationships you spoke about that Tishman has globally, how many of them broadly would really be a part of this space, so that we get some comfort in terms of your leasing activity towards the end of the tenure of the fund?
See, what's happening in most of the commercial property, almost half of it is absorbed by the IT sector as we know it. And the other half is divided between the BFSI, the pharma, the EdTech, the startups, the flexi office space. So they take the rest of it. As you know, both the IT sector as well as all this BFSI and all of them have been doing extremely well. And that is one of the reasons behind this growth and spurt in commercial property absorption. As far as the tenant roll call of Tishman is concerned, it is not just the tech companies they have done. They've just leased out a building in San Francisco to Meta, the Facebook, erstwhile Facebook, of 800,000 square feet. But it's not just the relationship with tech companies. What we are seeing actually is the bigger companies are doing the back-end operations or offshoring activities in India. India is fast moving from the BPO call center tag we had to what we would call as a KPO. So if you see the big companies, whether it's a Rolls-Royce or a Mercedes or a Siemens, they all have their back-end offshoring operations also out here. And it is with these companies that they have a very strong relationship. Already, we find that almost 50 to 60% of Fortune 500 companies are in India looking at offshoring operations. And most of these companies are the tenants of Tishman somewhere in the world globally. So if Tishman has a tenant like Capgemini in Paris, it's very automatic and very easy for them that Capgemini is also their tenant in Wave Rock, Gachibowli, because that becomes their first port of call for them, and they're very comfortable with Tishman, who has been with them for decades as their landlord. So I think we will see a lot of these offshoring activities giving an impetus to this commercial property absorption. And it is this, I think, where we have an advantage through Tishman, that they become their first port of call and gatekeeper. They understand the requirements, and even when we are choosing, like today we are term sheeting something in Pune. Why we are term sheeting it in Pune? Because they're already talking to potential tenants who might not sign up now, who might sign up a year later. But they know that Pune is on their radar and they're wanting and favoring Pune to compare to some other city. So basically, your entire strategy moves because you're constantly getting a feedback loop from these prospective tenants who are wanting to come into India.
Sure, thanks. There's a question on the break-even occupancy levels required in tier 1 or tier 2 cities in India from a cost, I think, perspective.
See, from a cost perspective, everybody would require at least an occupancy level of 65-70% at least in order to break even in today's thing. But most of us, we will not rest easy till the occupancy levels go above 90%. Ideally, everybody wants to be above 90% and keep the vacancy levels in single digits. Uh, in a wave rock, the vacancy levels is not just in single digits, it's in a decimal point because it's 99 point something, their occupancy. So everybody would prefer to be as highly occupied as ever. But at a break-even level, you might even break even at 65-70% occupancy.
So just to sort of extended question from what Mr. Arun Khanna asked, general trend that you're seeing across the Indian commercial real estate space, what's been the occupancy level now post-COVID, now that most of the people are back to work in offices?
It has always been around 12-13%. It went up by a few hundred basis points. So you will see it around 15-16%. And again, it is slowly trending down. But if you look at a macro headline number, then it is generally around 10-12%.
Sorry, I was meaning the occupancy levels.
It is the flip side of it.
Okay, so upwards of 85%, you're saying. Okay. Another question is on Tishman, since it's a global player and you referred to the work that they've done at with the Wave Rock property in Hyderabad, or the model or the approach that they would have taken for that entire project. So what portion of their overall global portfolio or business would be something similar to what they've been doing at Wave Rock, so that it gives comfort in terms of what to expect from them in maybe participate in this fund?
I think what they have done in Wave Rock is exactly what they do globally all over. If I leave out their little ventures in life sciences and data centers, which are very different asset class, but when it comes to an office space as an asset class, Wave Rock is right up there with any of their buildings because the amenities they have put in, the design, the development, what they have done, it is up there. So I don't see it as something which they have done it in a slightly cost-cutting manner. So I would tend to believe this is the sort of a hallmark, and this is the sort of a signature style of Tishman buildings. And we would continue to do such structures even in the fund, because we will not differentiate it in any way.
Sure. A question on the fact that a lot of large global IT players are aggressively adopting cost-cutting measures. Could this in any way have repercussions on domestic portfolios here?
This is a good question because they are cost cutting, but what has happened? This has actually happened the reverse way. It's good for us because when larger companies are cutting their costs, that means they are looking for more effective solutions. So, and one of the best effective solutions for us, given our labor cost, is still India. Even our property cost is still $1 a square foot on an average. So when you look at that, you will automatically realize that it is far better than to offshore your operations to India and other developing economies. rather than be in high cost sort of centers. So it is going to give a further fillip and impetus to our what we are saying, rather than go back on what I'm saying.
Sure, understood. One interesting question on whether the fund is going to take any leverage. What would be the purpose of this leverage, if at all, and what sort of a ratio to the client equity in the fund?
Correct. The fund is not going to take any leverage, but at an SPV level, where we are going to do the project, they will take leverage of a debt equity ratio 1:1. And we intend to take construction finance. And debt equity of 1:1 is a very safe thing, so that we get the best construction finance rates also. So, and that will help us in the financial closure. And it will also be a positive arbitrage for the returns that will come to the shareholder, which is the fund unit holders finally.
Sure, thanks. If there are any further questions, I'll request participants to please type them into the Q&A box. Could wait for a minute for that. Great. I don't think there are any further questions at this point in time. Balaji, Sushant, thank you for your time. I think this was a fruitful session. Would have given better insights for the participants in terms of what to expect in the commercial real estate space going forward, and also from the fund in that sense. Thank you, both of you, for your time. Participants, that's all we have on this webinar. Thank you very much for having logged in to this call, and hope you all have a great evening and a great weekend thereafter. Thank you.
Thank you, participants.
Thank you.
Thanks.